Right now, we are looking at the live trading action for NVIDIA stock as the market moves through this Tuesday, April 21, 2026. The stock is currently trading at $201.80, which puts it up about 0.06% since the opening bell. It has been a tight, high-stakes tug of war today between the bulls and the bears, with the price carving out an intraday range between a low of $197.84 and a high of $202.17. While that might look like a quiet day on the surface, what is happening under the hood is actually far more dramatic. Most people are focused on the fact that we are sitting near all-time highs, waiting for the next spark, but the reality is that we are seeing a massive shift in how the biggest players are positioning themselves. While the retail crowd is busy checking the Robinhood app or browsing the latest trending tickers on various investing sites, the institutional desk at Fidelity Wealth Management and the high-speed algorithms over at Interactive Brokers are wrestling with a technical paradox. The expectation you'll hear in most social circles and online investing forums is that NVIDIA is an unstoppable train, especially with the Blackwell Ultra chips finally hitting the scale and the new Rubin architecture visible on the horizon for late 2026. People see the $4.9 trillion market cap and assume it's just a matter of time before it crosses the $5 trillion mark. However, the reality of the current tape shows that we are hitting a massive wall of Fibonacci resistance at the $201.91 level. We have seen the stock try to peek its head above that ceiling several times today, only to get slapped back down by a wave of automated selling. This creates a fascinating tension. If you are using something like the Fidelity mobile app to track your portfolio, you might just see a green number. But if you look at the Chaikin money flow, which tracks institutional buying pressure, it has actually been dipping into negative territory over the last several sessions. This means that while the price is staying high, the smart money has actually been quietly trimming positions into this strength. It's a classic case of distribution happening right in front of our eyes while the public sentiment remains overwhelmingly bullish. If we look at the broader landscape of online investment right now, there is a lot of noise about the Federal Reserve's next move. We saw some Federal Reserve leadership hearings yesterday that kept the market on edge. The general expectation was that we would get a clear signal on interest rate cuts by the summer, which would be a massive tailwind for high-growth names like NVIDIA stock or Apple stock. But the reality is that inflation remains stubborn, particularly with energy prices creeping up, and that is forcing a reevaluation of valuation multiples. When you have a stock trading at 41 times earnings like NVIDIA is today, any hint that the higher for longer interest rate environment will persist acts like a gravity well. This is why we are seeing such a fierce battle at this $200 level. It's a psychological line in the sand. For those of you managing your own individual brokerage accounts or perhaps using a Schwab Intelligent Portfolio setup for a more automated approach, this is the kind of volatility that tests your conviction. The trading volume today is sitting around 338,000 shares in the early going, which is relatively light compared to the explosive days we saw back in February after the record $68.1 billion revenue report. That lower volume on a slight up move is often a warning sign. It suggests that the buyers aren't exactly aggressive here. They are just waiting to see if the 197 support level holds. If we see a break below that intraday low of 197.84, things could get very slippery very fast. Let's talk about what is actually driving the company right now. We just saw NVIDIA announce their Icing quantum AI models earlier this month, which is their attempt to move beyond the traditional GPU space and into the next frontier of computing. This is the kind of news that keeps long-term investors in things like Fidelity ETFs or Fidelity mutual funds comfortable. The business model is shifting from just selling hardware to becoming the literal operating system for the global AI economy. Their data center revenue reached a staggering $62.3 billion in the last quarter alone. To put that in perspective, that is a 75% increase from a year ago. Most companies would be thrilled with 10% growth. NVIDIA is doing it at a scale that is almost difficult to wrap your head around. They are generating so much cash that they returned $41.1 billion to shareholders in the last fiscal year through buybacks and dividends. Even with that, they still have over $58 billion left in their buyback war chest. However, there is a disconnect between these fundamental masterpieces and the current technical setup. If you were active on the SoFi trading platform or checking your Robinhood investments daily, you've probably noticed that the stock has been on a 10-day winning streak, up about 18% in that window. That is a parabolic move. Usually when a stock moves that far, that fast, it needs to breathe. The RSI, or Relative Strength Index, is currently screaming at us, sitting above 71. In the world of technical analysis, anything above 70 is considered overbought. It doesn't mean the stock has to crash, but it does mean the risk-to-reward ratio for starting a new position right here at $201.80 is not exactly in your favor. The more likely scenario is a retest of the breakout zone around 193 to 196. This is where the psychological game of expectation versus reality really kicks in. The expectation is that because the AI demand is exponential, the stock price must also be exponential. But the reality is that markets move in waves. Even the strongest companies in history, like Tesla stock in its prime, had periods of 20 to 30% drawdowns during their largest bull runs. We are seeing a lot of retail FOMO right now, where people are jumping into Robinhood fractional shares just because they don't want to miss the move to $212, which was the previous 52-week high. But the institutional activity we are seeing on the Interactive Brokers platform suggests the big desks are actually selling those shares to the retail buyers. Now, I want to hear from you on this. Comment below with how many shares of NVIDIA you are currently holding in your portfolio, and let me know if you are buying more at these levels or waiting for a dip. It's always interesting to see the split between the long-term holders and the active traders. Looking forward, the next big catalyst is the earnings report coming up on May 20. Between now and then, we are in a bit of a news vacuum, which means the stock is going to be hypersensitive to macroeconomic data. If we see the dollar continue to strengthen, or if the Fed becomes more hawkish in their rhetoric, the self-investing crowd might start to get nervous. We also have to keep an eye on the competitive landscape. While NVIDIA is the king today, companies like Amazon and Google are pouring billions into their own custom AI chips. They are still customers of NVIDIA for now, but that is a long-term risk that the market is currently ignoring. The reality is that NVIDIA's gross margins of 75% are a giant target on their back. Competitors want a piece of that pie, and eventually that margin will face pressure. For those using Fidelity brokerage or perhaps looking for investment help through Fidelity Wealth Management, the advice usually stays the same: don't chase the high. If we look at the technical chart, the 50-day moving average is all the way down at $183. That's a long way to fall if the market decides to take a breather. The gap between the current price and the moving average is historically wide, which usually points to a period of consolidation. You might see the stock move sideways for a few weeks, which would actually be a very healthy thing. It allows the moving averages to catch up and the overbought indicators to reset. The story of NVIDIA in 2026 is one of a company that has exceeded every possible expectation on the fundamental side, but is now battling the reality of its own massive valuation. You have a company valued at nearly $5 trillion that is still growing revenue at 65% a year. That shouldn't be possible, yet here we are. But as an investor, you have to separate the company from the stock. NVIDIA, the company, is a world beater. NVIDIA stock at this specific moment on April 21, 2026 is a high-priced asset sitting at a major resistance level with momentum indicators that are starting to look a bit tired. In summary, the expectation is a smooth ride to new all-time highs above $212, fueled by the agentic AI hype and the Blackwell ramp-up. The reality, however, is a market that is technically overextended, facing institutional distribution and a tricky macroeconomic backdrop that could favor a short-term pullback. We are seeing a massive tug-of-war at $201.80, and the next few trading sessions will be critical. If we can't close decisively above $202, we are likely looking at a trip back down to the 190 range to find more buyers. Whether you are using SoFi active investing or sticking with your Fidelity IRAs, the key is to stay grounded in the data rather than the hype. The trend is still your friend, and the trend for NVIDIA is up, but even the best friends need a break once in a while. We'll be watching the volume and the institutional flow closely as we head into the afternoon session to see if the bulls can finally break this Fibonacci resistance, or if the bears will finally get their chance to push this back toward the moving averages. Stay disciplined, keep an eye on those support levels, and remember that the reality of the tape always wins over the expectation of the crowd in the long run. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.